real value of cash is it gives you optionality, meaning if things start crashing around you and you've got a nice slug of cash, you're the one who can go shopping. The correct answer is there's no one single asset. The key is diversification. And that sounds obvious. Well, of course, we know that you're supposed to diversify, but people don't really know what diversification means in practice. For example, I run into people all the time. They go, well, I'm highly diversified. I own 50 different stocks in 10 different sectors, technology, consumer non-durables, minerals and mining, et cetera. And I say, no, you're not. You may have 50 stocks, but you have one asset class, which are stocks. And they tend to be highly correlated. And certainly in times of stress, they all go down together and they all go up together. So real diversification consists of a basket of assets that don't particularly correlate to each other. So what would that basket look like? There's room for stocks. I'm not saying get out of stocks completely, but you need to be selective. I would say the energy sector, mining sector, agricultural, basically commodities, hard assets look attractive. In terms of fixed income, high quality government notes, so Australian government obligations, but for a lot of the world, U.S. Treasury obligations. Pick a maturity that you're comfortable with, 10-year notes, 5-year notes, 2-year notes, all the way down to short-term bills. We have a funny situation right now where the yield curve, so that's the shape of the curve. So you have time and interest rates on the y-axis. The yield curve is supposed to go up, meaning if I lend to you longer, I want a higher interest rate because I have more risk. That's not the case today. It's inverted, which means that the longer maturities have lower interest rates. So you can actually buy something pretty safe, like a 1-year Treasury note or the equivalent Australian government obligation, and it has a higher rate than a 30-year bond. And so you kind of get the best of both worlds. You get less volatility, less risk, and a higher return. So have a slice of that. I've always recommended gold, but don't go overboard. I recommend 10% of your investable assets. And I exclude your home equity in your business. Don't gamble with the roof over your head and however you make a living. But of your investable assets, maybe 10% of that in gold. I also recommend a large slug of cash, and maybe as much as 30%. And people say, well, gee, why would you have cash? The yield is very low. I don't get much out of it. Well, that's true, but number one. But number two, you don't lose money. So if the stock market goes down 30%, you'll be happy with your cash allocation. Cash could be your best performing asset in deflation. Don't exclude the fact that we could flip from inflation to deflation very quickly. But that aside, the real value of cash is it gives you optionality, meaning if things start crashing around you and you've got a nice slug of cash, you're the one who can go shopping. You can go out and buy things down 30%, 50% from where they are today, and then catch the next wave up. So I would say that the right strategy, the best strategy is a diversified portfolio. Some equities, but be selective in your choices. And again, hard assets, agriculture, mining, energy, et cetera. Big slug of cash, maybe as much as 30%. Gold, real estate. Be careful. I say residential more than commercial, and certainly income-producing real estate. If you own rental properties or farmland, agricultural goods, and there's a place for private equity with that. And high-quality U.S. government notes. So that diversified portfolio will serve you very well.